What are butterfly spread options? Butterfly spread is an option strategy that traders are neutrally attempt to profit from the options trading and help to protect their position if the stock moves in the direction other than expected. Your investors open a call or a put option and add another call or put option on the same underlying asset with the same expiry date. But the strike price is different. It involves 3 strike prices to carry out 4 trades altogether. Let's understand how it works. A butterfly spread is a combination of a bull call spread and a bear spread that have an overlapping middle strike price. The strategy consists of buying an out the money option call above the current stock price and buying an ITM in the money call option that is below the current stock price, and also selling 2 at the money calls near the current stock price. The investors can either take 4 butterfly call option or 4 butterfly put option or a combination of both. And what are the different types of butterfly spreads? Option includes long call, short call, long put, short put, iron and reverse iron. Have you known about this concept earlier?